Good morning and welcome to the Coffee and Cap Rates podcast, your go-to source for New York City's latest commercial real estate insights. This program is brought to you by Ariel Property Advisors.
I want to start by saying that since 2022, we've experienced interest rate growth that really lowered valuations in pretty much every product type. And I'm standing here, coffee and cap rates after coffee and cap rates, and saying the same thing. So what has changed? One of the things that has changed in the past 18 months is we started seeing investment patterns. And for simplicity, we tried to divide them into three main categories: the deep bench, development, and assets under stress. I'm going to talk about those. Then I'm going to speak about what to watch for, the watch list. Then we're going to invite our great panelists here. We have two lenders, three owner developers. It's going to be super exciting. Let's start with the big numbers. $13 billion of transactions, very similar to what we've seen a year ago. But these $13 billion are not the whole story. There's some transactions behind the scenes that are not shown on this here, and we'll talk about them along the way. When we start with the three categories, I want to start with the investors' favorites assets, or what we call Fabulous Four. And these are office, Class A office buildings, free market multifamily, affordable housing multifamily, and retail. We're going to start with Class A office buildings. There, the story is the deep bench of tenants, top-tier tenants that are taking about 3 million square feet in the past 6 months alone. What does that do? It pushes rents in Class A up, and vacancies are down about 7% in the past 2 years. So that's drastic, and that affects transactions of Class A office buildings. How so? 74% of all office transactions are in the Class A category, and 58% of that number is in recapitalizations. The other note that you should see, or the other fact, is the fact that $8.3 billion was the refinance number that we've seen in the past 6 months. These are the buildings that traded. They're pretty beautiful. But one of them is a good example because it shows you how an owner wants to keep and hold on to a Class A, how an investor wants in on the Class A action, and how a lender is interested in the Class A as collateral. And that's 1345 Avenue of the Americas. There we've seen Fisher Brothers bringing in Blackstone, and together they raised a CMBS loan, a new CMBS loan in the amount of $850 million. The building is 92% occupied. Tenants like Fortress and Paul Weiss, and got a major makeover in 2021. If that's not enough, we have about 16 million square feet of Class A office that's being either built or rehabbed right now for the benefit of more tenants. Now, these tenants, they do need to live somewhere, and that brings us to the next asset class in the Fabulous Four, free market multifamily. What's the demand driver there? It's the unstoppable rent as a result of undersupply of housing, consistent undersupply of housing. But there's one more thing. The basis in the free market world is still low. We're talking about 24% compared to peak, and we've started to see some growth in valuations as of last year, which means that the investor conviction strengthens. There are three main asset classes within free market that we're looking at. Tell him I'll call him back. And I want to touch on each one of them. The first one is the institutional newer buildings. They're very similar to Class A office buildings. The sponsors want to stay in. So you take Taconic, for example, bringing in Aris into their health kitchen deal on West 52nd Street. They're staying in the deal with Steiner, buying out their existing investor and staying in that deal. The second section or sector of free market are the decontrolled, mostly in Manhattan and Brooklyn, multifamily buildings. There you see institutional investors like Hub, who's here with us today. Thank you for being here. I saw him before, as well as Carlyle last year, but also people that are private or have some private money like Peak and City Urban that investing in this category. The last section of free market are the smaller tax class protected free market buildings. The investors there are private. They're in many cases syndications, in many cases international as well. There's one more thing before I move from the free market. It was also transactional from a financing perspective. More than $5 billion of refinances took place in the past 6 months. There's another category of multifamily that is part of the Fabulous Four, and that's affordable housing. What's driving that? It's the incentives. It's the government incentives and the private-public partnerships. The investors there are mission-driven. They want to provide quality, affordable housing, and they need to see a return. These are private groups, these are nonprofits, these are institutions. Very excited to have Meredith Marshall from BRP here with us today. They are a major affordable housing platform. And one of the things he might or might not tell you is that the incentives are super important because many of these platforms are national. And because of that, New York City is competing with other locations. One of the deals that took place, or the largest affordable housing deal that took place earlier this year was related selling to Treadway, which our company, Ariel Property Advisors, brokered. That was an $88 million deal, 602 units, where Treadway managed to extend affordability for a long time and reinvest in the asset for the betterment of the tenancy there. One other thing that's interesting about this specific asset class is capital that's invested kind of behind the scenes. So you saw Sixth Street Capital going into another big platform called L&M. And you don't see that transaction as part of the total transactions that we've shown before. So there's a lot of activity there. A few years back, it was Stone Point investing in Omni, eventually selling to Nuveen. So there's a lot of activity in general in this asset class. And the last of the Fabulous Four is retail. And retail has done really well in prime locations. We've seen Ralph Lauren and Uniqlo this past 6 months buying on Fifth Avenue and Prince Street. They're joining Gucci and Prada from last year, if you remember. But there are also institutions like RFR that joined Blackstone and Acadia from last year, buying in prime locations, and private investors like Premier that are looking at retail in prime locations. So a lot of that is happening. These are the Fabulous Four. They account for about 50% plus of all dollar transactions. And that brings me to the second category, which is a great category, called development. So what's driving development? It's the rezonings and it's the housing policy of last year. And there are several categories that I want to touch on. The first one is the ground up rentals. We saw more than 127 transactions happening in the past 6 months, but most of them are smaller buildings, less than 99 units. Why is that? It's because the housing policy provided a 485X tax abatement and said if you're developing above 99, there's a major wage requirement. What do developers do? They buy smaller buildings or smaller lots to develop smaller buildings. And there are exceptions. One of them is 175 3rd, which is in the Gowanus in Brooklyn, and I'm excited to have Charney Companies and Justin from there to speak about it. That's a 1,000-unit construction site. How come? Because they managed to get the old 421A, which shows us how incentives work when you're an owner-developer and want to develop bigger buildings. You probably need to use this one and not the new 485X. Condominiums, driven by underlying fundamentals, growth about 9% year over year, 37 transactions in prime locations. That's more than the 31 we've seen last year. Our capital services group will tell you that we see a lot more lenders willing to lend on condos, so there is momentum there. And lastly, when it comes to development, it's the conversions. It's the office to resi conversions that definitely affected by the housing policy, lifting the density cap and allowing for the 467M tax abatement. The city is telling us there are 17,000 units that are already in the pipeline as a result of office to resi. And we'll tell you that there are about 13 buildings that traded in the past 6 months also for office to residential conversions. Tom Ortino from GFP is here with us today, and we're excited to speak with them. They're pioneers when it comes to office to resi. They're developing 25 Water and a few other buildings, but he and his team were prominent and helpful with structuring the 467M or talking to the state about that. So we're excited to speak with you about it when you're ready. That kind of concludes the development side section of this presentation. And I want to say that we know that we're missing or short about 500,000 units, and that's going to happen by 2032, which means that we need to develop about 60,000 units every single year. We're not. We're developing at most half of it, which means that we're behind consistently. But I do want to give credit to both Adams and Hochul for their try. They're doing well, or they did well, trying to advance a policy that allows for more construction, and that's important to mention. But what happens when you don't have incentives, or when the incentives were taken away? That brings assets to distress. We're going to talk about two specific asset classes here: office, that's B and C, and rent-stabilized multifamily. Let's start with the office. These are office buildings that for this reason or another cannot be converted. It's zoning, or it's the path to vacancy, or the buildings are not conducive to conversion, or something along these lines. And there are two types of owners there. The owners that are not distressed, they're under-leveraged. They have the wherewithal to find tenants, to occupy the buildings, and do well in the short term, believing that over time, supply will come down because nobody's building B and C, and some of them are going to be converted. But the other type of owners are those who are over-leveraged, cannot afford to bring new tenants and rehab the buildings, and so they're selling at a major discount, and we're seeing this here. Now, it's not a deep bench of buyers, but it's enough of a bench to know where these deals can trade today, and they're trading because of operational distress. The rent-stabilized multifamily market, it's a little bit of a different story. It's where we saw the perfect storm. We had a legislation that took away the ability to increase rents. We had exponential expense growth. We had very high interest growth, and that lowered valuations by as much as 91% in the past 6 months. Now, the average valuation drop is about 50%. But all of these buildings traded in the past 6 months, and also between 2015 and 2019. So these are real discounts. If you think about it, someone bought a building for $1 in 2018, you give them back 50 cents. That's what's happening in rent-stabilized multi. Now you have to ask us, our company, Ariel Property Advisors, does a lot of that business. Who's buying it? The buyers here are long-term viewers on New York City. They're attracted to the lower bases. That's one of the only reasons they buy. And there's one more thing. They think that HSTPA, the Housing Stability and Tenant Protection Act of 2019, is an unsustainable legislation. They have a good reason for that. 50% of all rental multifamily is rent stabilized. It's 1 million units. And the incentive to invest is just not there. There's no reason to put money back into these units. They're dilapidated. If you look at the violation counts, they doubled over the past few years. The city putting more buildings into the AEP program than before. And so things will have to change. And at the end of the day, the city and state will have to say, it's either we're providing subsidies and making those buildings maybe affordable housing, or we're providing the incentives for private money to reinvest and grow rent. The silver lining in this distress is that no matter what you have or what problems you have, you always have buyers. And I love that about New York City. That brings me to the watch list, and to start wrapping this up and in a minute call the panelists. So the first thing on our watch list is policy and politics. I want to start with the mayoral election, and I'm going to say very little here. Remember that the real election is in November. And the question is whether the new mayor's policies are going to attract capital or repel capital. That's what we need to know, and that's what we need to think about, I think, in oversimplified terms. The other thing that's related to policy is the big, beautiful bill, which helped low-income housing tax credit by relaxing some of the requirements for debt, as well as adding more budget for the 9% credits. This is going to help ground-up construction and probably also preservation. We're waiting for the state to tell us how it works, and maybe Meredith can tell us more about what he knows, if he knows. So we look forward to that. Capital and liquidity. Capital and liquidity is a big deal when it comes to clearly everything investments. We have more than $350 billion of liquidity in the market, of money that's ready to invest, dry powder. About 20% of it was raised about 3-4 years ago. And that means that we have to use it or lose it, which will push more transactions. Many platforms like Blackstone and SL Green continue to raise money, and some of it is for equity, some of it is for private debt. There's a lot of non-bank debt, and one of our speakers here is going to speak about it. That's Jesse from Derby Copeland, and we look forward to hearing you. But that's a super interesting category of what's happening in the market. The last thing is global investment is here and is here to stay. It's coming through the different platforms as well as direct. Some of it is because of the weaker dollar. So where are we in the cycle? We think we're in an upswing, not an aggressive upswing, but we definitely saw some growth in valuations as of last year. So in conclusion, one of the things I encourage you to do is to read our reports. They're a lot deeper than what I've done here. And if anything, I hope that we gave you a window into the momentum we're seeing in New York City. But I want to leave you with a few questions. What type of investment, what type of major bets are you willing to take today in this market? And what type of risks are you still concerned about or holding you back?